Hello, beautiful people. Joe Corbisiero here, Dream Homes Team, CEO of the Dream Homes Team, powered by Compass. Today, I'm going to share with you a couple of ways to finance a home that is a little different than the regular financing you're going to see out there and that being offered by banks. So you probably never heard of this before. I personally bought and sold and also helped clients to buy properties through those methods. So I'm going to share with you a couple. I'm going to start with the first one, AITD. What does it mean? It's an all-inclusive trust deed. The AITD, I'm going to go a little deeper into it in a few seconds. Then we have something that's called an assumable loan. I'm not sure if you ever heard of it, but there's a lot of loans that are assumable. Then we have a seller financing. Then we have something called silent second. And then finally, we have lease-to-own, which I personally bought a property many years ago. So I'm going to be guiding you through all this different type of financing that you can take advantage, especially on the market like this, where there is way less competition and less sales. I'm going to start with the first one, AITD, all-inclusive trust deed. So let's see, for example, what does it mean? First of all, this is fully insured by First American, Chicago Title, or any insurances out there for title insurances. They will do an AITD insurance on it. So let's say the purchase price is $700,000. The seller has an existing loan of $500,000, and let's say they had it at a 3.5% interest rate a couple of years ago, right? Follow me on that? Now, what's going to happen is, let's say the buyer is purchasing this home for $700,000. It's going to put down $50,000 as a down payment, which goes straight to the seller, and then the seller is going to do what's called an AITD for $650,000. Basically means the seller becomes the lender. So it's putting together or embracing, I should say, the existing loan with the new loan. So the total loan amount here is going to be $650,000. So let's say you negotiate a rate of 5.5%. Now the seller becomes the bank, you buyer paying the mortgage to the seller, correct? Usually those are for a shorter time frame. They're not for 30 years. They give you an opportunity to buy the home, but most likely 5 years, 3 years, 10 years. Obviously it's negotiable. And you end up making payments of 5.5%, which is lower than the rate, today's rates. So this is a great method for people that they have usually a substantial down payment. I recommend you more than the $50,000. Otherwise it's hard to convince a seller to do an AITD. Today I want to also to tell you a little more about some creative financing. This is one actually of my favorite, the seller financing option. I purchased multiple properties from single family homes, condos, all the way to multi-units and apartment buildings. This is, for me, it's the bread and butter when it comes to investing. So the beautiful thing about the seller financing, you actually can negotiate anything about it. Starting from the down payment, the terms, you want to fully amortize, you want to interest only, what is the percentage, the length of the loan, and so on and so forth. So today I'm going to just share with you the basic thing that you, in order to have a seller financing, the house or the property, I should say, has to be free and clear. Otherwise we get into the AITD situation, which I explained in a different video. So like I said, there's a full negotiation on everything, on the terms. So we actually, in 2023, we did help 2 different buyers to purchase a home and a piece of land with a seller financing options. So it's live, it's still here. You just have to work with the right people that can put a deal together. For example, if you're purchasing a home for $700,000 and it's free and clear, I know you might think it's hard to find, but you'd be very surprised. There is a lot of homes, especially in the outskirts, that they've been owned by a trust or elderly people, and they use it as a rental for many years, and they decided at one point that they don't want to deal anymore with tenants. There might be some complications as far as to get all the funds together, or they rather have everything in the trust, therefore they're willing to do a seller financing. That's why we step in. We're going to help you negotiate the best terms and conditions. Obviously, I don't want to put your hopes up, but a seller financing, 99% of the times, it's usually for a shorter term. It's fully amortized for 30 years, but you can't keep that loan for a 30-year term. They usually give you 3 to 5 years or 10 years, and once again, we have to negotiate that. We also have to negotiate the down payment. We have to negotiate the terms if you want to do fully amortized, such as principal and interest or just interest, which reduces drastically your monthly payments. Another great option that I wanted to share with you today is the assumable loans. Probably now that we're November, December, less sales here in San Diego County, interest rates a little higher than we're accustomed to. There's a lot of opportunities out there. We are able to filter and offer you properties that have assumable loans. Not many people know, but you can actually also assume an FHA loan or an VA loan, even though if you've never been in the military. The only difference is the seller has to agree to be on the hook with some sort of responsibility on the VA portion of it, meaning the county limits is $977,500. And then let's say they have a loan for $700,000 originally. Now, until that loan gets paid off, that seller that was in the military or is is eligible to get a VA loan, it means he cannot use the entire eligibility, the $977,500, because they already used the $700,000. So you need to find somebody that's agreeing on that. And most of the times we're able to negotiate that by just giving it a time frame for the buyer to pay off their loan or refinance their loan. So I hope that helps. Now, I'm going to give you an example, a practical example. So let's say a purchase price of $700,000, right? There is an existing loan of $580,000. Now you, buyer, can assume that loan for $580,000 loan and then get a down payment, put a down payment of $120,000. The $120,000 obviously goes to the seller. You assuming that loan, you making payments on behalf of the loan. You still need to be qualified and take over that particular loan. That's why it's called assumable. And the loan has to have in writing in the contract and the original loan agreement that is an assumable loan. So, and again, I always recommend if you're assuming a VA or an FHA loan, it's fair for all the parties to give it a 3 to 5 years. Therefore, there is a contract that you will be refinancing at that time. I hope that makes sense to you. I know it's a little more complicated. Those are not just the common, ABC loans that you see every day. You can walk into a bank. And the last two options I wanted to share with you in the realm of the creative financing is the sell in second and the lease to own. There's a lot to talk about those two as well. I personally use it for multiple purchases that I've done throughout my career and for my personal properties. The sell in second, not many people talk about that, but sometimes we want to buy a home that is a little more expensive, but we can't necessarily qualify for the full mortgage. So we're a little bit short of cash. So what we do here at Dream Homes team will help you negotiate what is called a silent second. The seller is willing to carry a small portion for a determined time that we will agree upon, and we obviously have to write the contract for it. And we'll call it silent because that particular trust deed is not going to be recorded right away. It will be recorded after the fact once you purchase the property, you get your mortgage and so on. If you have more information, reach out to me on that end. Now I want to talk to you about the lease to own. Oh gosh, this was huge about 8 to 9 years ago when we had a lot of short sales, when we start seeing the market crashing, probably 13 years ago at this point. And there's multiple parts that goes with a lease to own. So I wanted to just break it down for you. Obviously in a few minutes it's going to be almost impossible to really go deeper into it, so feel free to reach out for more information. Number one is the lease to own. There's three components. One is the lease. So you're leasing that property, so you are a tenant at that moment of time. Number two, so you have to obviously create a contract that will help you with that, that is going to stipulate what is your monthly payment as a lease, as a rent. Number two is the purchase agreement. From the moment you enter in their home, you're also stipulating a contract with the seller, agreeing on terms and conditions and a purchase price, which is going to determine as well when you're going to be able to purchase that home. And number three, which is very important, is the option to buy. The option to buy is a different form, which is basically a down payment. So that down payment is basically the opportunity, the option that you are buying and the seller is allowing you to create this lease to own option. The last time I did it for myself, one of the homes I purchased about 8 years ago, I put down $40,000 as an option to buy. And the option stays in escrow alongside with the purchase agreement. Now, all those three pieces, they're quite complicated putting it all together and create a lease-to-own situation. So for more information, if you're interested about those options, feel free to reach out to me directly. Follow me on my Instagram or YouTube or Facebook. My name is Joe Corbisiero with Compass and the Dream Homes team. Or you can reach out to me directly at 760-201-9252. Thank you for watching. Ciao.